Okay, so welcome to the Independent School Show Parents Forum. Today is the first forum of 2020 and the start of a programme of events building up to the show in November. Today we're going to talk about school fees and specifically the financial strategy to help families manage through the Covid-19 crisis. So I'm delighted to welcome you all today. We had over 230 registrations from families with one child in independent schools, and 165 from families with two children. 27 families have 3 children in the system, and 4 families are paying school fees for 4 children. 1 family has over 5 children being educated privately. So clearly parents are having to find large amounts of money to pay school fees at a time of great economic uncertainty. So I'm delighted to welcome James Alder and David Quintrell from Brewin Dolphin, who discuss the merits of different financial strategies for parents who are looking to find ways to pay school fees. But before we dive into the practicalities of paying fees, William Petty of Bonas Macfarlane will give an overview of different approaches schools have taken to fees and payments during the COVID crisis. Before our panel gets started, I've got a few housekeeping matters. Many of you have submitted questions in advance, and during the event, if you have questions, please use the Q&A button at the bottom of your screen. If you do this as we go along, I'll try and make sure that we cover as many of the topics raised as possible. The event's being recorded and will be available to watch again afterwards. And we'll email you this when this is ready. And there'll also be handouts from Brewin Dolphin and Bonas Macfarlane available with contact details. So Will, I'd like to pass over to you. Hold on a second. I'll just put the spotlight on you.
Thank you, Guy. Good morning, everyone. Welcome. Thank you for joining us. Just a little introduction from me from the overview. My name is Will, as Guy said, Will Petty. I'm from Bonas Macfarlane, and we're an educational consultancy company specialising in school placements in the UK and Europe and higher education in America and the UK as well. We also have a well-established private tuition business. So we've been monitoring everything from both angles for schools with our sister company, the Independent Schools Show, and looking at what's been going on in the run-up to lockdown, during lockdown, and the aftermath as it unfolds. The first thing today is to say that we're here to talk about planning fees regardless of COVID-19. It's not a discussion to sort of talk about how to deal with the new financial structures and the discounts, I'm afraid. It's really very specific from school to school, and my advice to all of you struggling with how to deal with whatever provisions your school have put in place with COVID in terms of fee discounts, in terms of reductions, refunds for deposits and things like that. The truth of it is that the thing to do is to approach your school about these matters. You've got to stay engaged with them. There is not going to be in the independent sector a kind of blanket approach. There isn't. The variation in discounts is as extreme from 53% off fees to 0. You have to bear in mind that many of these schools most of them run incredibly fine margins. So sort of small increments to the change in that are really dramatic for them. And it may well be the case that you're in a position where you feel you're paying quite a lot for not very much. But there is the very real threat for these schools that, without doing that, they simply won't survive. Indeed, we have seen school closures, happily not too many, but sadly some pretty well-established names, certainly in the rural prep school community, shutting their doors permanently. Just to quickly overview, there are discounts in place at most private schools for the term gone and the summer term currently active. Most haven't made a decision necessarily on next year, although that will be coming in the weeks ahead as the COVID measures from the government become clearer, which, let's face it, might take quite a while and not be very clear to begin with. Many schools, for parents who are there who simply cannot afford to carry on paying, have set up hardship funds. Some of these are funded by their own coffers. Some are being funded by voluntary commitments from other parents to help families in their community sort of see out their days, as it were. So it's really important you stay engaged with your school. Really important that you do hold them to account a bit and tell them about your situation, because they're not going to know unless you open a dialogue. So we'd encourage you to do that. We won't be able to answer specific questions about your situation today. There's too wide an audience, so forgive us, but we're going to keep the topics so that they apply to as many of you listening as possible, watching. But I and my team will be available to contact with any other matters and specific questions about personal cases, and indeed on the financial planning front, James Alder and David Quintrell will be there too, and we'll send all that information out during the broadcast on the chat, but also there'll be a follow-up email to all of you afterwards with the presentation from Brewin Dolphin and with all of our details, so that you can get in touch and we can carry on more specific discussions and help you wherever we can. So the other thing to say is that this is not a big chat about how to win bursaries and fee assistance at schools. What we're doing here is Brewin and Dolphin are very kindly coming to join us and discuss, if you've got the requisite assets, which they'll explain in detail, how you get the most out of that and how you plan for that to reduce the kind of overall burden of school fees going forward and make your money work as well as it can. And it is not, the barrier for entry is not prohibitive. So please, don't tune out. There's lots of things that the gents are going to discuss within their expertise, and I think you'd be surprised as to how accessible this might be. To quickly just tie that off, in terms of the bursaries, if you're looking in that world and you want fee assistance from schools, again, do contact the schools individually. You'd be very surprised what some very big name schools are willing to offer, even if your household income is perhaps higher than you'd think would qualify for bursaries. There is assistance for a really wide range of household income. So again, most important thing to do is to contact the individual schools. There isn't some central hub that is fantastic, although obviously the Independent School Show is an amazing place to get that information as a parent and as a kind of consumer of independent education. And hopefully we will be in Battersea Park again in November with 200 plus schools, and again an extension of these talks and the London Parents Forum there, going into greater depth about the fees assistance. But today we're just going to focus on the fee planning with our friends and experts at Brewin Dolphin. There'll be Q&A at the end, so I'm here to answer all the educational ones, and obviously look to Jamie and David to answer the fee ones. So do stay tuned for that towards the end. But for now, that's it from me, and I'll hand back over to Guy to introduce the Brewin Dolphin chaps.
Great, thanks, Will. As Will mentioned, scholarships and bursaries are a topic that we discuss in the show, but we will also be running an online event on that topic in this programme. So Brewin and Dolphin are going to be looking at efficient ways families can manage assets. Is that right, David?
It is, Guy, yeah.
Yeah, so can you give a brief introduction to Brewin and Dolphin, please?
Yes, I'll just share my screen. Hopefully you can all now see that and hear me as well. Thank you, Guy. Thanks, Will, too. And thanks to you all for joining us this morning. Please forgive the use of my air traffic control headset. It was the best way I could make sure that you could hear me without sounding like I'm broadcasting from the bottom of a cave. Over the course of the next 15 minutes or so, James and I will run through some of the key considerations in utilising existing assets and contacts in certain circumstances in order to assist with the payment of school fees. We've made certain assumptions that you, like many of our clients, typically have certain forms of investment in place already, or savings which you can draw for this purpose. This is very much a summary of how to utilise those assets and some of the considerations that should be accounted for in the short term when deciding how to cover school fees. It's not necessarily a particularly deep dive, so to speak, as to how you might consider structuring ongoing planning, and that's something that we're planning to cover in the next webinar on the 30th of June. That will cover that off in much more detail. As already mentioned, this is much more of a sort of headline summary, so to speak, and we'll cover off questions in Q&A too. By way of introduction to Bruins, as per the slide, Brewin Dolphin was established in 1762. We're one of the largest independently owned wealth managers in the UK. We have £42 billion of funds under management, 57,000 clients or so, 32 offices across the group in the UK and the Channel Islands, and a long history, most importantly, of working in partnership with our clients and their professional advisors to make sure we achieve their financial planning needs. Running on to the topic, just going to run through key considerations in 3 sections: the use of savings and investments, assistance from grandparents and wider family, and the use of other assets like business or property. I'm going to run through the first 2, and I'll hand over to James for the latter. On to savings and reviewing your savings. With interest rates at all-time lows, putting excess cash savings to work in other asset classes, be it property or the stock market, for example, offers the potential for higher returns and typically provides better protection against real life inflation, more importantly, school fee inflation. Many of you will already have made that decision in terms of looking at how best to utilize those monies to make sure fees are covered not just now, but also in the future through investment into assets offering better returns than cash. A key principle of investment, however, is to take less risk the closer you are to the time when you'll need to spend that money. With stock markets having been particularly volatile since the turn of the year, it's important to have a review of those savings to strike what we would deem to be a perfect compromise, if you like, between peace of mind, having monies on deposit to cover school fees for the next year or so, but not so much that the real value of the capital is being eroded by inflation, again, be it school fee or real life. One of the best ways of doing that is to undertake cash flow forecasting, which we at Brewin Dolphin use, and a number of other advisors do too. And we use cash flow analysis to help establish what the implications are in terms of drawing on particular assets or particular forms of investment, both in terms of their impact on plans now, but also future plans. For us, it helps demonstrate what you might need to save and invest to be able to maintain the payment of school fees during your child's education. It also helps consider the options available to you in terms of where and how best to release assets at this stage, be it an ISA, a portfolio, a pension, or potentially borrowing against property, and some of those options we'll come on to shortly. Turning quickly to risk profiles and investment mandates, I think quite often you forget that you've got flexibility in one's approach to investment and liquidity too, in terms of how you get money back. Wherever and however you have monies invested, you will have the flexibility to review the risk profile that you're taking in terms of those funds being managed or how they're invested. And that could be perhaps amended to reflect short-term needs and prevailing market conditions. Different plans or products also have different restrictions in terms of access to capital invested. Many ISAs provide instant access, while investment bonds, for example, could have exit penalties, and pensions cannot be accessed until you're 55. So again, it's looking across the broad spectrum of client constituent parts and determining the right place to get monies from. You should also have the flexibility to determine which form of asset class you could get monies from, and which could or should be sold at the point of withdrawal. That's particularly looking at the different types of underlying holdings in an investment portfolio, for example, to decide which it may be most suitable to sell in the context of your needs, but also current markets. Just touching again on the use of what conceivably could be excess cash on deposit, and considering investment into the stock market to maintain the real value of your capital and ultimately meet your aims and objectives of covering school fees. Where it's clear perhaps that a combination of existing and future savings, the plans you've got into place already, may not be sufficient to cover to medium-term or long-term school fee needs, especially where returns on cash are near zero, and then not exceeding school fee inflation either. It could be necessary and indeed advisable for you to invest a proportion of your savings into what we would refer to as risk assets. Clear guidance and advice should be provided on the level of risk that can or needs to be taken in terms of projecting those benefits forward to provide better returns than cash on deposit. History has shown that a balanced and diversified portfolio of investments across various asset classes and geographies will consistently provide better returns than cash on deposit and inflation. And clearly, and perhaps most pressing, is the impact of timing and the level of withdrawals that are made and where they come from in terms of your financial plan. The timing of withdrawals required, be that monthly, termly, annually, or indeed ad hoc, will inform us as advisors, but also you potentially as to how and where money should be held as part of a long-term plan, but also the amount of risk that one can afford to take in terms of the time frame for the investment of those monies. I'll just turn now to cover some of the considerations on where those withdrawals could come from now, using the three most common forms of plans in which school fees monies are held. For us as advisors, that's normally ISAs, what we refer to as ordinary investment accounts. Depending on where your monies are held, that may be referred to as a collective investment account or a general investment account, and investment bonds too. There are a myriad of plans and products available for school fee planning as such. There's no such thing as a specific school fee plan anymore, but often clients will earmark these sorts of investments and constituent parts for school fees itself. The first just to touch on is the flexible ISAs. The rules were changed in April 2016, after which ISA providers were allowed to make their ISAs flexible, in inverted commas. With a flexible ISA, you're allowed to transfer money in and out of that ISA each tax year without the withdrawals and the replacement of that money counting towards the annual £20,000 contribution allowance, as long as what is taken out is replaced within the same tax year. Government rules allow individual providers to decide whether or not to make their ISAs flexible, and often and many of those providers just converted and made their ISAs flexible. So you'd need to check with your ISA provider as to whether or not they've converted the ISA contract that you have with them to meet those flexible ISA rules. Some of those ISAs, some types of ISAs are not flexible, and any withdrawals have to be made on the basis of a set of rules rather than the flexible rules. The three main ones are junior ISAs, help to buy ISAs, and lifetime ISAs, where there are restrictions around that. But they're potentially a very good way of using ISAs for temporary savings without affecting your temporary withdrawals for school fee provision, knowing that you make a withdrawal now, you've got until the 5th of April next year to replace that, and it not affect your use of the allowance. Turning to capital gains tax considerations, certainly if you're looking to realise monies from assets which might be liable to capital gains tax, care certainly needs to be taken to ensure that gains are not realised above the annual capital gains tax exemption, which is currently £12,300. It's also important to review investments in the wider context of your affairs, as it may well be that you've actually got assets on which there are losses in portfolios, for example, which can be sold to either offset the gain or realise losses going forward. Losses, although no advisor really wants to talk about them, are actually an important part of planning where you have them, because losses can be carried forward indefinitely, and therefore actually even if you have an asset that's got a capital gains tax exemption, if it's sold now, losses brought forward from other years can offset that and assist with that form of planning. Where gains do exceed the allowance, obviously it's important to make sure that you earmark sufficient monies to pay the liability, which would be due this tax year, would be due in January 2022. And as James will summarise later, there are options in terms of how to release monies from investments where perhaps the sale of the whole thing would be seriously constrained by CGT implications or other tax implications in terms of the release of money from investment property, your own main residence, or businesses. And just finally touching on considerations for investments, just touching on withdrawals from investment bonds. I think investment bonds tend to be, certainly for prospect clients coming through the door with investment bonds, often feel they're opaque in terms of their structure, what they do and how they work. And bond is arguably the most overused word in our industry, with many products sold as bonds. There are a wide variety of them. What we're talking about here are investment bonds, which are insurance policies that are administered by UK-based insurance companies, where monies are invested in a series of funds. In terms of the withdrawals, and something that certainly is relevant for school fee planning, HMRC will permit the extraction of up to 5% of your original sum invested into that bond per tax year, per policy year, without an immediate charge to tax, as that's deemed to be a return of the capital that you invested. That 5% allowance is cumulative, and therefore you're able to take withdrawals potentially more than 5% over the course of the life of the policy. because it's deemed to be a return of the capital invested at 5% per annum, there is only really a tax liability of more than 5% is withdrawn in any one policy year or over that cumulative allowance. So 5 years with no withdrawals could see 25% of the initial investment withdrawn in year 5 with no immediate tax liability. The result essentially is that you as a UK resident taxpayer could extract 5% per annum without having to pay any immediate income tax liability. It's worth noting, just for sake of completeness, that if the contract was set up after 2012, advisor charges come off that 5%. So you may see advisors talk about a 4 or 4.5% withdrawal allowance, not a 5%. It's one of the nuances of the rules. But it's also very important to be aware that there are tax implications for taking out more than the 5% annual allowance, deferred or otherwise, and that there are ways of minimising any income tax liability if needs must, particularly referring to the family perhaps that have 5 children in the independent school sector, and ways of minimising that through assignment to lower rate taxpayers, not being resident for tax purposes in the UK in the year of withdrawal, or potentially encashing a part of the bond over the course of time. And again, James and I'll be happy to explain that in more detail. As with other forms of investment, and as mentioned a couple of times already, it's important to ensure that the investments that you have within the investment bonds are suitable for your risk profile, time frame, objectives, and most importantly, prevailing market conditions. Turning now to help from grandparents and wider family. Again, with James and I having been at Bruins for a combined 38 years between us, we come across this inheritance tax planning a lot, and a lot of grandparents wanting to help their children and families with assistance when it comes to school fee planning, and that will often form part of their own inheritance tax planning. Gifting money to grandchildren to cover school university fees has the additional benefit of reducing the potential inheritance tax liability that may be due on death, and a good many families will see that as a way of advancing inheritance when monies are needed, rather than waiting for the fateful day, so to speak. One can give away most assets, including cash, shares, property, but it must be an outright gift from which the donor can no longer benefit to qualify for IHT exemption after a set period of time, which more often than not is 7 years. There are a number of small allowances from HMRC, which will allow you to make gifts from your estate, which are immediately exempt from inheritance tax. You don't have to survive for 7 years to have that exemption and that gift fall outside your estate. And the allowable gifts that are relevant to school fee planning are essentially summarised as follows. The first is the annual £3,000 capital exemption, and that £3,000 can be split either between a number of individuals. In addition to the £3,000, any number of small gifts of £250 can be given to any number of individuals, as long as none of them had any of the £3,000. So conceivably, my parents could give me £3,000 and then give my wife £250. That £3,250 immediately outside of their estate. It's probably something I'll take up with them after this. And the final exemption is gifts in consideration of marriage, which may seem a little spurious, but hopefully I'll qualify that in a second. The gifts on marriage from grandparents or parents varies from £1,000 to £5,000, depending on the relationship to the donor, be they grandparents, nieces, nephews, aunts and uncles, and so on. And this has really come into play more often in the last 10 years or so, as couples maybe marry later in life after they've had children and they've got children already at fee-paying schools, get married maybe in their mid-30s, 40s, whatever it may be, and wider family wanting to make financial gifts that can be used in this way. Ultimately, HMRC will allow you to utilise the full £3,000 annual exemption from the previous tax year as well, if it wasn't used at that time. So technically, an individual that did not make use of the £3,000 allowance can do so for the 2019-20 tax year this year, in addition to the £3,000 for 2020/21. And that's free of IHT immediately. An often overlooked allowance is gifts from net excess income. HMRC don't quite often publicise that. If a gift is made habitually or regularly from net income, and that excess is given away and does not affect your ability to maintain your standard of living, then any amount of that excess can be given away and it is immediately exempt from IHT. To qualify for the exemption, it's got to be able, or you must be able to prove, or grandparents must be able to prove that the gift was made as part of normal expenditure, i.e. a regular occurrence, that it was made out of income, so pensions, ISA income, investments, whatever it may be, and that after allowing for those gifts that are made, the transferor, i.e. the person giving the money, was left with sufficient income to maintain their standard of living, not having to hack into capital to pay for their cost of living. Again, not often documented is that it's normally gifts from net excess income, net meaning after tax, but HMRC have confirmed that that income actually also includes ISA income, even if it's reinvested, still considered to be taxable, even though it's not. And equally less known, some tax-free cash payments from pensions, although it's very important to be careful around that. Documentation of gifts, both of capital and income, is key. It's for the executors of one's estate to prove to the revenue that capital gifts were made and when they were made and they were within those allowances. Finally, gifts over and above those allowances, because useful though £3,000 to £6,000 a year is, quite often grandparents will want to make a more significant start in support. It's possible to make further gifts to individuals over and above those allowances. These are known as potentially exempt transfers, or PETs for short, and the sole qualification is you must make that gift outright. You must have no benefit from it, and not be able to have any benefit from it once it's given, and you must survive 7 years from the date of the gift for that to fall outside your estate for IHT purposes. There are risks with grandparents planning or wider family planning. One of the dangers of making lifetime gifts is that you hand over money only to regret it later in life when it transpires to have detrimentally affected your own financial plans and your own security. And I'm sure as all parents will agree, normally parents will put their children first, grandparents will put their children and their grandchildren first, and often put their priorities over and above their own financial security. The key really is to give away what you can afford to, when you can afford to, and to take advice as to establish how much you can afford to give away and at what points in time. And the use of cash flow analysis, again, as mentioned before, is a brilliant support tool to us in terms of that planning. I'll hand over to James now. I appreciate we've run through things pretty swiftly, but James will now run through the final section on using loans to release monies from other assets, and I'll see you in the Q&A.
Thank you, David. Good morning, everyone. And like David, I'd like to apologise for my headphones, which I stole from my 11-year-old son at the beginning of lockdown. Looking at the making use of your assets, I think as Will said at the beginning of the presentation, you have to have some kind of assets to be able to use the ideas and options that we're talking about. But you don't necessarily have to have an investment portfolio. Great if you do, because it's probably the easiest way to draw down short-term money to pay immediate school fees, subject to tax, of course. But you could have other assets, and we sort of identified the three main assets, including the investment portfolio, as a business, a main residence or second property, and an investment portfolio. Now, with markets being very, very volatile, I mean, they've increased really well in the last few weeks, but there was a significant fall in markets at the beginning of lockdown, and we may have some choppy waters ahead. It may not be a great time to take money out of a portfolio, given that assets might be worth 20% less than they would normally be. And or you might have capital gains tax considerations, which means you need to gross up the amount you withdraw to take account of the tax that's due. So one of the options is to look at taking a loan or borrowing against your asset. Interest rates have fallen in the last sort of 3 or 4 months quite significantly before lockdown, and there's a possibility that they could fall even further. So if we're looking at someone's business, for example, you could actually take money from your own business. This is a very complex area. There's two main areas really with loans to and from businesses. It's first of all important to make sure that the business has sufficient assets so that when you take your loan, you're not leaving the business, short and unable to trade. So it's really important to make sure that there's a healthy business there to take your assets from. If you're simply taking money out of a business, you're really limited on what you can withdraw in terms of the amount and the term. Under £10,000 and for a period of less than 9 months, you can withdraw money from a business tax-free. And we see this with loans for train fares and things. I mean, I have a rail fare loan from my company, and that's tax free. I borrow the money and I pay it back monthly. Over £10,000 and longer than 9 months, you then run into some very, very tricky and complex rules where there's not only net tax for you necessarily, there's also potentially tax and NI, national insurance considerations for the company. So that's a really complex area that if you're needing to withdraw from your business, if it's your only asset and there is money in there, you should really get some good advice from an accountant. Clearly, you can withdraw or take dividends in the usual way, but if you're already taking dividends and you're a high rate taxpayer, there may be an opportunity to take a loan from the company. And how tax efficient it is will depend on the amount, the term, and the circumstances. But just to clarify, advice is really key in that area. The other side of a business is where you may have lent the business money to begin with to seed it with some capital, which you may have forgotten about, or it's still within the company. That's much more straightforward. You can ask for a repayment of your loan at any time, and that's a really good way of withdrawing capital from a business tax efficiently. So that might be a better option than just taking a loan in the first instance, which has the tax considerations I explained. Main residences. I mean, people in London may have significant property value, houses and second properties that they can draw on. Even if you have a mortgage, there are opportunities to withdraw capital from your property. And as I said, rates are very, very low at the moment. They're the lowest they've been for many, many, many years. I spoke to a mortgage broker a few weeks ago during the lockdown, and the problem at that time wasn't that the supply of money wasn't there. Banks are desperate to lend. I mean, we see this. They're offering holidays on loans and things and mortgages, which really, is a good way of them actually making more money, incidentally. But they are able to loan. It's not the financial crisis that we have at the moment isn't like the 2008 banking crisis. The money is there to lend. The desire is there to lend. The problem has been valuers haven't been able to go out to properties and value them. Now, a week or two ago, the easing of the lockdown meant that the valuers could go to houses. And I've noticed, talking to my mortgage broker this week, that the housing market has started to pick up. And I don't know if anyone saw on Rightmove this morning, but they've had a record number of interest in their website in terms of people looking at properties and looking around to see what's available. You could go to your current mortgage broker or lender and ask them for an advance on your borrowing at the moment. I would suggest that you get expert advice on this. Even if you have a mortgage, I think you should go to a broker to see if you can get the best deal out there. Often the difference between deals is quite significant. Being furloughed isn't necessarily a problem. In fact, in a way, it's a help to the lender, because the lender knows that the income that the individual is getting in every month is guaranteed by the government. So being furloughed isn't necessarily a problem, but you do need income, whether it be furloughed income or your own normal income, to be able to borrow money on a mortgage. If you are a little bit older, in your mid-50s, and you have children coming out of school or going into university, you could possibly qualify for an equity release mortgage. And that's a very, very good way of borrowing money without any immediate repayment. It rolls up against the value of the property. Many, many years ago, equity release was viewed as something you shouldn't do. There were lots of schemes out there that were very, very poor for people, but the market's really cleaned up its act now, and it is possible to borrow money at around 2.5% in the right circumstances from the equity release market. And it's definitely something we will focus on more when we talk later in the year on the help from grandparents. That's very much something that I think could be used in that scenario. Loans against an investment portfolio. As I said earlier on, hopefully you have a portfolio and it's locked with gains. That's a good thing. The fact that it's got big capital gains in there means that it's done very well. But that causes you a problem if you want to withdraw money, because you have to gross up the net money you need by the tax that you're going to pay, and that could be 20% at the highest rate. So it is possible to take a loan against your investment portfolio so that you can actually release money without any tax considerations, without any market considerations. A lot of pension funds use this sort of technique when they use put and call options. They're basically not selling the investments that they're in the fund because it's the wrong time, so you can actually borrow against it. So that's a really good way. Interest rates on this aren't overly expensive, around about between 1.5% and 3%. So it's quite an effective way of withdrawing money from your portfolio. And as I've already said, it's good if you've got locked-in gains, or you just don't want to draw down on assets that have recently lost 20% in value. You'd rather wait, let them recover, and then the recovered assets can then be used to repay the capital down the line. So they're the three main ways I think that you can withdraw money from your assets. There is one further thing that I thought I'd say. Clearly, we need to look at the situation. What if one or both of the parents who were funding the children's school fees were to pass away? With COVID-19 sort of, in the world at the moment, that isn't beyond the realms of possibility that someone in their 30s, 40s who's currently paying the school fees could pass away, sadly. So looking at insurance is very important, making sure that if the main breadwinner or if both breadwinners pass on, there is a pot of money there that can continue to pay the school fees. Taking the children out of private school when they lose one or both parents, it would be a horrendous thing, I think, for them. And that's just something that is part of your sort of financial MOT, as we call it, is to look at your life cover just to see if there's enough life cover in place to cover risks should one or both the parents pass away. I think that pretty much covers my area. So I'll pass back to Guy, who I think has possibly some questions for us to try and answer.
Great. David, do you want to stop sharing the screen? Thank you. Brilliant. So we're now moving on to the Q&A section. And I've had quite a few questions in already, both from people in advance of the event and in using the Q&A below. If you want to ask any more questions as we go along, please just use the Q&A button to ask your question. So the first one is quite specific about furlough. My husband and I have been furloughed, and we have an investment called an offshore bond. We were led to believe that there are horrendous tax charges and penalties on these investments if money is withdrawn. Can you tell us if these investments can be used to pay the school fees while our income is insufficient?
So I'll take that, James. I think I mentioned it in the summary before. It's the use of an offshore bond is an investment bond. Offshore just means it's administered in a jurisdiction outside of the UK. So most of the ones for UK residents are in Dublin or the Isle of Man or Luxembourg. Historically, they were seen as we said earlier as opaque and difficult to sort of understand. The short version is that the horrendous tax charges aren't necessarily horrendous. You've got the use of the unused withdrawal allowances, or if you're using them all the way through, the use of the withdrawal allowances up to 5% of what you invested, to be able to take money out of that bond with no immediate tax charge. And again, briefly mentioned, and possibly one to take up afterwards, you can assign ownership of some or all of these bonds to a lower rate taxpayer. So if you have one spouse who's a higher rate taxpayer, and one spouse who isn't, or a partner and so on, you can mitigate the potential tax liability in that respect. And it's just worth checking with your provider or your advisor with regards to the position with regards to penalties. They can tend to be provider specific rather than generically across all investment bonds. I don't know if you'd add anything to that, Jamie.
No, I think you've covered the main things, David.
Thank you.
Okay, great. So the next one is we've just paid school fees for the last term, but our business has gone bust because of coronavirus, and we have no investments, but we have a company pension scheme, and we're not sure if we can access this money and how this money would be taxed if we took it out.
I'll take that one. I think David alluded to in his presentation that you need to be 55 or over to draw down from your pension, and that's any pension, whether it be a company pension, a private pension, whatever. So depending on how old you are, if you are over 55, you can draw down on your company pension, your private pension, whichever pension arrangement you have. In terms of its taxation, up to 25% of the pension fund can be taken tax-free. And the balance of the fund, the balance of the 75, you take it all in one go, can be used to provide an income which could be subject to tax depending on your circumstances, or can just be left to roll up. You have to be careful if you're drawing on your pension that the pension has sufficient flexibility to be able to draw the cash that you need. If you don't need all of the tax-free cash, you want some, you need a flexible arrangement. But most arrangements these days are flexible, or you can move your pension into an environment where it is flexible. So I think it's possibly a very good option for this person, depending on how old they are, to take up to 25% of the value to help pay school fees. The one note of concern for me would be, I doubt whether the company pension scheme was set up in the first place to pay for school fees. It was probably set up for tax reasons for the business to get money out of the company into the pension fund tax efficiently, and would be for the individual's retirement. If a large chunk of the school fees, the pension fund is going to be used for school fees, then there's going to be a shortfall in retirement down the line. That may be okay because there may be sufficient time to put money away in the future. Hopefully the business can be revitalized, or a new job can be gained after coronavirus. So more money can be put back in. You have to watch how much you put back in when you've taken tax-free cash, because there are quite strict rules on that. But it is possible over time to put more money in. And I think it's a very viable solution to people who really just only have that as their main asset.
Great, thanks very much, James. So this one I think is probably for both Will and Brewin Dolphin. So our son's in his last year of school, and we just about manage each year to pay the fees, but we cannot afford the fees for his last year. With no cash or investment pension funds, and we're at our wit's end. Is there any help available?
I'll take the beginning of that. Thank you, Guy. As I said in my introduction, perhaps rather hurried, was the first place to start discussing this is with your school. Many private schools are being as understanding as they can be, and putting in place as many measures as possible to help people, quite specifically often in your case, to make sure that they can finish the school if they're just towards the end of their time there. This has been done through hardship funds, some of which in some smaller schools are being funded by other parents, in fact. In larger schools with charitable status, you'll find that they have this, they may well have this in place. It's not often very well advertised, so it's really important to get your figures correct, be clear about the assistance you need. Presumably, you could afford a portion of it still, in which case, that you're not asking necessarily for the full 100% of the year's fees, and therefore, you might be much easier to help in terms of the school's view of things than say someone needing 100%. And yeah, really, it ends there from me. You just need to speak to your school and be really open about them. I as yet am not aware of any products that have come into place in the COVID days for your situation, and suspect anything is a modification of something pre-existing. But first things first is speak to your school and speak to them as soon as you can. I'll hand over to David or James to answer the more financial aspect of that.
I think I'll take that one, Will. Not a great deal, other than I think this is a prime example of where you might go to your parents, the bank, grand bank, and just see if it's possible for them to help an early inheritance, for example. The benefit of that would be you'd get the money to pay the fees that you need to pay, but also if it's a successful gift, i.e. your parents survive for 7 years and it falls out of account, there's also a 40% inheritance tax saving there, which effectively means there's a 40% saving on the school fees. So I think that might be where you go along and talk to your family, either a loan or a gift. A gift is much more efficient, by the way, than a loan, because the loan stays in the parent's estate and is subject to inheritance tax. But that might be a good opportunity to have a discussion about that, so that you can keep your children in school. Okay.
Great, thanks. We've had a number of questions about ISAs. So I use my ISA allowance every year, and I have ISA investments on which I could draw to cover school fees if I had to, but I'm not keen to do that. because once the withdrawal from the ISA is made, I cannot put the money back in without using my £20,000 ISA allowance. And someone else also asked a question about junior ISAs, children's ISAs as well.
Sure, I'll take that. As far as the use of, I suppose, adult or investment ISAs are concerned and cash ISAs, as I mentioned earlier, the government rules changed in 2016 to allow providers to offer flexibility in terms of withdrawals. So it's conceivable that in that instance, if the provider has changed the rules, that person can make withdrawals from their ISA to cover school fees and put the money back, in addition to their £20,000 allowance. The withdrawal and the replacement of that money, as long as it's in the same tax year, is separate from any allowances. The difficulty with junior ISAs, help to buy ISAs and lifetime ISAs, is that the government has placed very severe or very strict sets of rules about accessing. And the query about accessing children's junior ISAs to help cover school fees, unfortunately, that's not possible. The government does not allow money to come out of a junior ISA or child trust fund, as was, until that child is 18, regardless of the circumstances. So flexible ISAs are the only ISA that you can take money out of and put back.
Great, thanks, David. We're going to start to move quickly because there's an awful lot of questions coming in there. We've got various questions about assets, actually. So following up on what you said about borrowing against the house, someone says, I've been furloughed and can't pay my children's school fees. I have no cash, investments or pensions, but my house is worth a considerable sum. I don't have a mortgage. Can I borrow against it? Someone else has asked, they have very valuable classical musical instruments. Can they secure against those? And various people, someone else has said they've remortgaged just at the beginning of lockdown and now have a considerable amount of cash sitting in different accounts. And given the volatility of the markets, would it be better to invest that money or to pay the school fees as a lump sum?
I'll try and take those. I'll start with the musical instruments one. I've no knowledge at all of borrowing against musical instruments. I suppose technically it's possible. If it's a valuable asset, then it may be that's possible. But I'll have to possibly go away and get some more information on that. So if we'll leave our contact details and we'll try and make sure that we get that and answer that one. In terms of the borrowing the mortgage against the house, yes, as I said earlier on, rates are very, very low at the moment. There's the appetite to lend. Borrowing money against your main residence or a second property is viable, is possible now. Also possible if you've been furloughed. So as I said earlier, you do need to have some income, but it can be furloughed income. But yes, I think of the three options that I outlined, I think probably borrowing against the property at the moment is most efficient in terms of the interest that you would pay. And also, as long as you have a sufficiently small loan to value, you can get very good rates, and it should be quite straightforward to set up. And the appetite is there. Will, can you remind me of Guy? Can you remind me of the last question? Sorry, it was the last bit.
Should you pay if you're already remortgaged? Should you invest it or pay the school fee?
I yes, the market is volatile at the moment. It's had a very good run in the last month, I have to say. My view would be you shouldn't really be putting money into the stock market unless you have at least preferably 5-year time horizon. Yes, it might be possible to put money into some shares that have fallen and sell those shares in a couple of months' time and make some money. That's possible, but I think it would be very, very foolish to risk the school fees money in the market. I think you'd be much better off having enough money to cover school fees, not only for the next term, but maybe for the next 12, 18 months in cash, so that they're paid. Hopefully by then, coronavirus will be behind us, the economy will have picked up, everyone will be back at work, businesses will be thriving, and hopefully things will normalise, and there'll be no need to action the things that we've raised today.
Great, thanks very much, Jamie. And actually, the final well, sorry, there's lots more questions, but the next question is on a similar sort of vein in a way. It's about timings, and there've been quite a few questions in that sort of and about the economic predictions really. So, given what's happened to property values since the start of the year, do you have views on the timing of making these withdrawals from investments? And someone else has asked, what about hyperinflation and the risk of that? How do they protect themselves against that?
I'll cover the timing issue. It's very difficult. We always say to our investors, as soon as you know that you need a capital sum in a period of time, whether it be 3 months or 6 months, you're probably best to raise the money at the point you know that you're going to need it, rather than risking further volatility. The market is up. I was just looking earlier on. I think the market's had a great day today. It's up. Well, we're nearly at 6,300. So the market's recovered from just shy of 5,000 to 6,300 in a month or two. 2 months. That's a very, very good recovery. But I think it's early days, and I think the market is going to be very, very choppy over the next 6 to 12 months as the fallout from coronavirus and the lockdown begins to take momentum. My view is that if you know you have a liability within a shortest period of time, raise the money. It's a good time at the moment. The market's at a recent high. I wouldn't be necessarily waiting to see if the market got even better. Or I'm a great believer in life of not an all or nothing approach. Raise some now, raise half now, and wait until nearer the time to raise the other half. Something like that. Then you're hedging your bets, and you won't kick yourself either way if you do that. If you get it wrong, you've only got it half wrong. David, do you want to talk about inflation?
Yeah, I mean, I suppose just treading on investment management colleagues' toes. I think the reality of trying to use cash, whilst it gives you peace of mind that it's there, the real value, the physical value that you see in the balance only goes down if you spend it. I think the difficulty is that with returns in cash at maybe 1% on savings at best, and you've got school fee inflation probably riding at 3.5% to 5% a year in normality, the real value of that cash is going to be very difficult. So you're in essence you're almost forced, for want of a less dramatic phrase, to put your money to work and to take risk and to look at investment in assets which historically have risen in value either in line or in excess of inflation. And there are a variety of assets that a balanced portfolio would go into. So it could be index-linked gilts or equities, be they UK or internationally oriented. And that's where, the reality is I think it needs to be done on a case-by-case basis. You're looking at individual circumstances, aims and objectives, the school fees, whether they're day or boarding, how many children, what age they are, and so on. And that's, again, where the advice of or where the individual advice to each client is bespoke, and the importance of an individual plan comes into play.
Just to finish off on that, this isn't necessarily for coronavirus situations, but generally when we talk to clients about investing for school fees, we provide a cash flow model, but we also provide a structure of how those assets should be in place. And the first 12 months, it might be prepayment with the school if you can get a good discount. Years 2 and 3, it might be high interest cash. Years 4 and 5, we would invest in equities with the view that they might make sufficient gains over the period to be able to give us some good returns. So that's more of a longer term plan. But I totally agree with David's comments on the inflation. There are assets out there that can cope with inflation. Equities long term should definitely be part of a portfolio, but index-linked gilts as well, to give the portfolio some support when we have these volatile times, should also be considered.
Great. An interesting question about loans. Are there any loans available on the market that mean I don't have to borrow against assets?
I'll take that very quickly. I mean, there are, but unsecured loans will tend to be comparatively very expensive, and there'll be, again, for want of a better phrase, the kind of payday loans. So they can, because they're not secured against anything, the lender will take the view that there's a much higher risk of default, i.e. not that not being paid back. So it's broadly akin to sort of credit card rates or above. And I think I saw in the Q&A there was another question about being able to put school fees onto credit cards. And I'm not entirely sure. I don't see. I imagine it would be down to individual schools as to whether they were happy to deal with that. I think in my experience, most will have clients signed up for direct debit or something like that. But if it's a cash flow issue, as Will was saying earlier, it's conceivable that having a conversation with the school administration team or the bursar, and they may accept that. Again, with the caveat that the interest you'll pay if it's not repaid could be 18, 19, 20% per annum compared to secured loans of 2.5, 3.
Just to follow up on that, I think you could, if you've got income from employment or furloughed income, there are some pretty keen rates on from personal loans from your bank, for example, that isn't necessarily that expensive. But I think where you can secure against an asset, you're really into the very, very low rates, and that would be the preferred route, I think. But talk to your bank to see if they're offering a personal loan at 3.5, 4% at the moment, which isn't that bad in the grand scheme of things, and will possibly get you out of a hole if you've got a problem. And even if you view it as a very short term loan, make sure there are no penalties and things for paying off. But that might be an opportunity if you have no actual assets to set a loan against.
Okay, so final question before we kind of wrap things up. There have been several questions about overseas family and overseas assets. So, for example, what someone's asked, their main properties in the USA, they haven't lived there for 6 years. If we sell, will we get taxed on capital gains and other exceptions if the funds go towards education? Someone else asked about grandparents who were overseas and family who were overseas and the impact if they gift.
I'll start that, James. You can kick me under the table or chip in. So just turning to the main property in the USA question, because the asset is in a non-UK jurisdiction, it may be that the state or there may be state or federal taxes on capital gains realised that would be for the IRS in the USA to determine. And knowing what I do of the American tax system, it's unlikely that the IRS would not want anything with regards to the gains. But as a UK resident, if that individual is a UK resident at the point in time that asset is sold, UK capital gains tax is payable on worldwide assets. So it's conceivable you could pay, the highest rate of capital gains tax on an investment property here in the UK is 28%. It's conceivable that if it's 15% in the US, that 15% goes to the US the IRS, and the balance is paid to the UK HMRC. And just in terms of gifts from grandparents who are overseas, the allowances and the IHT regime that I mentioned here is for UK domiciled individuals, so grandparents who are domiciled in the UK. So again, a bit like the CGT position in the US, it's conceivable that it's the jurisdiction in which the grandparents live from giving. So in Australia, for example, there is no such thing as inheritance tax. They have a wealth tax, so gifts can be made without a 7-year survival and so on. So it's important that they take advice themselves in the jurisdiction in which they live.
And just to add to that, in the second question, the IHT scenario of gifts coming from overseas, David's absolutely right. It's really the jurisdiction they're in is relevant as far as the rules. But you're receiving a gift. There's no, you don't pay tax on receiving a gift. You do in the UK if the gift you've received is above the free allowance that you can give away, and the person who gives the gift doesn't live for the 7 years. It could be that you do have to pay some tax down the line. But in terms of a receipt of a gift, it's cash as far as you're concerned, and the IHT and the rules around the gift are relevant for the country the person who's made the gift lives.
Myself. Thanks very much, James and David, and Will as well. I'm going to ask all the panelists to put their contact details into the chat, where I will also put the web address schoolshow.co.uk, which is where you'll find recordings of this event, recording this event shortly, and handouts from the panelists with more details about what they were talking about today. Our next event is also listed on that site. It's on reception and admissions. Schools may be closed, but admissions haven't stopped. This online event will help parents understand how the leading London nurseries and pre-prep schools are managing admissions process for reception 2020 and 2021 during lockdown. So if you want to find out about open days, assessments, shifts in deadlines because of COVID, this is the event for you. And then the next financial event that we're doing with Brewin Dolphin is on the 30th of June at 10:30. And this is going to look at the choices available to pay for a child's education, the benefits of planning, how to position your existing savings, and exploring how gifts from grandparents can cover fees while forming part of a wider family inheritance tax planning. So lastly, I'd just like to thank everyone who attended and our panelists for their really excellent contributions.
Thank you guys.
Pleasure.
Thanks, James. Thanks, David.
Okay, bye.
Likewise, thanks all.